Evening viewers, this is our last part as far as IAS 16 is concerned, PPE, and in this video we are going to look at one of the past paper number, and we are going to be getting this question from May 2019, question 5A. And the required says we are going to be showing the extracts for the company's financial statements, reflecting the movements for the year using cost model and revaluation model. Basically, what I want you to understand is that when we are looking at IAS 16 PPE, we tried to look at how are we going to be measuring the cost. Sorry, how are we going to be measuring the assets of PPE using, first of all, we try to look at initially what are we recognizing. We said we recognize these elements or items of PPE at cost. That is initially the cost we have incurred. But we went ahead and we said that these costs that we are going to be incurring in purchasing these non-current assets that are going to be used in the business, they are not only the purchase price. We consider so many things, as we saw in the first theoretical aspect that we had, and we looked at the purchase price and other incidental costs that are going to be directly attributed to the asset. Then we looked at the other item of the unavoidable costs of dismantling and restoration of the site after the useful life of the asset. We try to look at some of the exemptions. What are some of the things that are not supposed to be included within the cost of an asset that we are going to recognize initially? And one of them, we looked at the pre-production costs or the startup costs that are incurred to test the asset, to test the asset whether it can be able to meet the normal production before actually the actual production begins. If you do those pre-testing of the machine, that because by the time you start doing the pre-testing, it means the asset is now already functioning. That one is not supposed to be included. Even their losses, you've done that pre-production and you've sold what you have produced, but you made a loss in that. Those losses are not going to be recognized within here. The other one, the administrative costs that we may incur. We've been training staff on how to handle the item. We've installed in a new machine and people need to be trained. They are relevant costs, but as far as determining the cost of the asset is concerned, they are irrelevant. So they are supposed to be expensed as and when they are incurred. So basically, we try to look at all that, and this question is going to be testing us on that. Or it was actually those people who sat, they were tested on that. What are the things that are supposed to be incorporated in the cost when we are initially recognizing an item of PPE? Then we try to look at, because when you see the question saying and using cost model and revaluation model, it means the question is now looking at the measurement basis, or how are we going to be measuring? Okay, they have given us the method. They are measuring PPE using cost model and revaluation model. but these are more or less the ones at subsequent measurement or at the reporting date. Which figure are you going to be taking when you're using the cost model? Which figure are you going to be taking to the financials when you're using the revaluation model? That's basically what we are going to be looking at. And that will mark the end of our simulation 4, which will have, at least by the time we'll finish this question, we'll be having some light whereby you can be able to attempt more numbers. Before I forget, there is a trial number. That's a trial number. That's August 2017, question 4C. You can try to look at it. When you have at least gotten some idea from this, we'll be able to have something. That's basically what we can talk about. Let's go through the question and you see what the question is telling us to do. But what I could advise, whenever you've been given a question, first look at the required. By the default, when you look at the required, by the time you read through the question, you know what you know what you want from the question. When you look at the required and you see you can't attempt the number, just ignore and look for another number, because at the end of the day, you may read through and you reach at the required when you can't even interpret. And it will need you again to reread the number, which will be consuming time. So basically, without wasting time, let's try to look at, so we know what we want, we know what cost model is, we know what revaluation model is. Let's try to look at the question in detail and you see what we are going to be having. They're saying the Uganda Minerals Limited is a company engaged in the exploration and evaluation of gold in Uganda. UML acquired machinery on 1st December 2013 at a cost of is 1st January, not even December. Let me to use this. 1st January 2013 at a cost of 50 million. We have other costs that we've incurred, meaning this 50 million was the purchase price. If we had trade discounts, we could deduct them, or rebates, we never had one. They're saying other costs incurred to bring the machinery to use included 10 million for site preparation, 5 million installation costs, 8 million professional costs. Then the useful life of the machinery was estimated to be 20 years. It's UML's policy to call out a revaluation of all items of PPE, property, plant, and equipment every 5 years. Then they went ahead and said on 1st January 2018, the same machinery was revalued to 60 million with assessed useful life of 16 years. Then we have the required. They are saying required prepare extracts for UML's financial statements reflecting the above movements for the year ended 31st December 2018 using 1 cost model and 2 revaluation model. That's basically the year they wanted us to prepare these books is 31st December 2018. But when you try to look at the question, you see that they have given you figures of 2013, 2018, and all that. So basically, we said when you are handling a number of these assets, what you have to first find out whether the assets are going to be depreciable assets or they are going to be non-depreciable. Having confirmed that maybe the asset is depreciable, because here we are talking about machinery, they are not land, meaning they are going to be depreciated. So having known that these are depreciable assets, in your mind you start understanding what are some of the the deductions that are going to be charged to an asset, to a depreciable asset. They have given us the useful life, and that's basically the information we have. We can go to can try to go to Excel and see how we can be able to interpret what we have got, solve the question. Okay. Try to enlarge this and be able to have something that can fill the screen. That can be enough. Okay, it's UML. Then it's better whenever we are dealing with the assets, you make sure that you look at the days, the date we are reporting and the date when these assets were acquired, especially when you're dealing with depreciable assets. So it's ML, but for the year, meaning we are looking for the year, for the year ended 31st March, 31st December 2018. So that's basically what we can get from that. Maybe try to highlight a bit. If you try to get the information we have, but they have not, what you have to understand is that they are telling us we are going to be using the cost model, but they have not given us the cost of the asset. So we need to first of all determine the cost of the asset, the initial cost, what they actually paid to acquire that asset. We spoke about the items that are going to be included in determining the initial cost of the machinery. And one of them we said it's going to be the purchase consideration, purchase price, or the purchase cost, which was 50 million in the question, 15 million. And we have to add other incidental costs that are directly attributed to the asset. Let me zoom this one a bit. Try to put the 15 million here. $10 million. And you first add these other costs that are incurred, and we are saying, when you try to look into the question says we incurred other costs to bring the asset to use, meaning all these assets were incurred in bringing the asset to use. If these costs are not incurred, it means we can't operate the asset. So that's basically what you look at. If you see that, first compare, if at all I'm not incurring this cost, will I be able to have this asset functioning? If the answer is yes, then we are not supposed to include that cost. If that cost is not incurred, the asset will not operate. So it means all those assets are going to be, all those costs are going to be accumulated, and we add back to, or we capitalize them to the purchase price that was paid. And we are saying the other costs include 10 million site preparation, 5 million installation, 8 million professional costs. So we add all of that, and we are seeing site preparation. The next one is installation. The last one was professional fees. We are seeing that the professional fees, they were 8 million. Yeah, 8 million. Installation was 5 million. And site preparation was 10 million. So this one is installation. So when you sum these up, you'll be able to get sum these up, we are going to be able to get 23 million. And on this 23 million is what we are going to, when we add this 23 million plus the other 15 million, which is the purchase consideration, we shall be getting the total initial cost that was paid to acquire the asset at the acquisition date. Initial cost of the machinery, total initial cost of the machinery, of the machine, is going to be the other one plus this one, which will give us 73 million. And this 73 million is now going to be our cost that we are going to be using when we are dealing with this asset. So that's basically the total initial cost that we incurred in the acquisition of that asset. So having known that, then we can be able, because now if you don't have the cost, then there is nothing you can do. But since we have got the cost, now this is the cost that we incurred on first. Actually, this one we could put, it was on first January 2013. That's when they bought this asset. Like this one bought. So if that was the cost, then we go into what the question wants us to have. Then we are saying that Roman one wanted us to use the cost model and see what we are going to be having at the end of cost model. but this one is at the end, which is 31st December 2018. So which figures are we going to be using, or which figures are we going to assign to this item of PPE at the end of the year 2018? And we said, first of all, this is reporting, so we expect you to do some narration of what actually do we mean by the cost model. What is cost model? Those are the things you are supposed to first narrate. First say that when you are using this cost model, of course, we look at, because when you don't, for a person who doesn't understand, or the person who doesn't have an accounting background, will not understand what cost model is. But when you are, before you actually answer what they want, or before you prepare these financials, you have to first explain what cost model is. You do the computations. After doing the computations, then we can do the extracts later. And we are saying the machine, because now we are accounting for this machine. We are saying that the machine will be measured at cost less accumulated depreciation, since it is a depreciable asset, accumulated depreciation and accumulated impairment loss. And that's basically what cost model means. Cost model means that the machinery are going to be transferred, or they are going to be valued using the cost model. But through the cost model, we are saying that it is the cost minus any accumulated depreciation and accumulated impairment losses that the asset has suffered up to the point when the reporting is going to be done. So you can write something small like that. It will give someone a background of what you're doing, even if the person may not be having an accounting background. So we try to look at, because we said it is going to be the cost with less accumulated depreciation. So this is supposed to be accumulated depreciation. Accumulated depreciation and accumulated impairment losses. They didn't tell us that the asset was impaired. So we are only going, our concern is now on the depreciation. Let's try to look at the annual depreciation, because we've seen the asset was acquired on 1st January 2013, and we are doing our reporting on 31st December 2018. It means there are so many years which have gone, meaning the asset is going to be depreciated. Annual depreciation is going to be equal to, when you are getting the depreciation will be equaling, because here they have not given us, they have just given us the useful life of the asset. They have given us the cost of the asset. That's all we have. We don't have any scrap value. So we use the information we have, and we'll be able to get what we can be able to get. It will be the cost minus, here less any scrap value if it is there. Scrap value or residual value. Then this we divide by the estimated useful life. Estimated useful life of the asset. So we've got our cost. Our cost, we computed it, and it was annual depreciation. Annual depreciation will be equal to 73 million. The total cost we computed here, we divide by the useful life. Useful life, they said it was 20 years. If it is 20 years, then you find what is going to be the annual depreciation. And this will give us 3.65 million. That is the annual depreciation That is the annual depreciation. But remember, this item was bought on 1st. It was bought on 1st January 2013, and we are reporting on 31st December 2018. It means from 1st January 2013 up to 31st December 2018. That's when we are reporting. So it means the asset has been there from 2013. That's 1 year, because we count on also the 2013 because it was there at the beginning of the year. Meaning that the whole of 2013 it was there, 2014, 2015, 2016, 2017, and 2018. Even 2018 we count it because it is at the end of the year, meaning the asset was there for 6 years. If the asset was there for 6 years, it means this annual depreciation, the annual depreciation we computed here was only for 1 year. But now we need to get the accumulated depreciation. We are supposed to get the asset would have accumulated from the time it was acquired until the time we are reporting. This will be the annual depreciation of 3.65 million. $3.65 million, we multiply by 6 years to get the accumulated depreciation for all those years the asset was there. That's how we get the accumulated depreciation. Then now we need to know the carrying amount, and we said to know the carrying amount of the asset, it is the cost less accumulated depreciation and accumulated impairment losses. Here we are going to be looking for the carrying amount, because carrying amount is what is going to be taken to the balance sheet. Carrying amount. Carrying amount is going to be the 73 million, which is the cost, we less the 3.65 million times 6 years. When you do that, you will be remaining with 51.1 million. And this carrying amount is what we are going to be taking to the balance sheet. But this depreciation is now going to be taken to our balance sheet, our statement of financial position as an expense every year. That's basically what they wanted us to prepare. If you have got all those figures, what you can only say is that we prepare these statements and we try to show them. We try to show them what we are going to be taking to the financials at the end of that year. But remember, these people wanted us also to look at the revaluation when we are using the what? The revaluation. Let's first complete this and look at the statement. Statement of financial. Remember, this statement of financial position is we have three. It is a statement of cash flow, statement of balance sheet, and profit and loss. Let's start with the profit and loss. Profit or loss. Passive income for the year. For the year ended 31st December 2018. This carrying amount is what we are going. Sorry, this one we are only taking the expense, but the expense we are not taking for the whole years. We are only taking for 1 year that they have requested us to do, which is the depreciation for only 1 year. Remember, this depreciation is it is going to be accruing every year. The 3.6 is going to be there every year on a straight line until the useful life of the asset. So for us, we shall be taking only the 3.65 million. And we look at the statement of financial position. Financial position as at 31st December 2018. And we look at, this is going to be under PPE. We can say machine or machinery. The other person just say PPE, and you put the carrying amount of 51.5 million. And you are done. Those are the extracts they wanted. From there, you get it was allocated 6 marks, but I know some of the marks were for determination of these figures. What happens here is that if you fail to know which costs are supposed to be part of this asset, it means you are going to get everything wrong, because you will be computing all the depreciation on a wrong figure, and at the end of the day, you will be getting wrong answers. So if you don't know what is supposed to be included on the initial recognition of the asset, please, you better not attempt the number, because you'll be computing everything that will not give anything. And that's basically what number 1 wanted us to do. Then we can try to look at Roman number 2, which was suggesting for. This one is talking about the revaluation model. Say these are the measurement bases that we use when we are accounting for these assets substantially. 18. Even here, what we are looking at, one, we are looking at the depreciation. We are going to take to the statement of financial position, and we are also looking at the carrying amount of the asset at the date of reporting. That's what we are looking at. But if you try to look at, to go through into this question, the question says, now this is where we are starting with the revaluation. They are saying it's UML's policy to carry out a revaluation of all items of PPE every 5 years, meaning every 5 years they do a revaluation. But we said with the revaluation, there are scenarios that may happen. One, we may have the value of the asset going to be less than the carrying amount of the asset, or it will be the opposite. The other thing is that it doesn't mean that if the useful life of the asset was supposed to be 20 years, it should be the same useful life when they carry out the revaluation. Because what revaluation does is that they even try to look at what is the remaining useful life of the asset after they have done the revaluation. So it doesn't necessarily mean that you are going to be having the same useful life at the time of evaluation, because these estimated useful lives, they're just estimates. Someone can overstate or someone can understate. Doesn't mean that it's supposed to be equal or supposed to be more or less. Anything can happen, because you may say that the asset is going to last maybe for 20 years, and you find out that the asset cannot even reach 5 years. It happens. And if it can't reach there, then it means even the amount you are going to be getting as the recoverable amount will not be exactly the same, depending on when you have kept maybe other factors constant. That's basically what we can look at, because they are saying they did the revaluation on 1st January 2018. But in our question, we are making the reporting at the end of the year, meaning from 1st January 2018 to 31st December 2018, that is 1 year. For them, they did the revaluation 1 year before the reporting. So now we are reporting when we have gone 1 year ahead. So it means, what this statement means is that if they have done the revaluation on 1st January 2018, and they have given us the revalued amount of 60 million and the useful life of 16 years, what we want to know is that what is the carrying amount of the asset from the date it was acquired until the date it was revalued. So when we know those two values, the carrying amount from the date the asset was acquired up to when the asset was bought, or was revalued, then we can know that either the asset has been affected by either a gain or a loss on revaluation. That's basically what we look at. Now, we don't compare the cost, but here we are comparing the carrying amount of the asset. In the previous videos, we've been looking at the cost of land because we said the land cannot be depreciated, but this asset now is a depreciable asset. So if it is depreciable, it means by the time it reaches, or by the time they did the revaluation, the asset has suffered some depreciation. So we are supposed to first deduct the depreciation and we get the carrying amount of that asset at the same date when the revaluation took place. When we get that, then we can be able to compare and see whether the asset has been revalued or we compare to find out whether the asset has had a gain or it has been revalued downwards. So that's basically what you can look at. But remember, the date when they did the revaluation is not at the same date we are reporting. So after knowing whether there is a gain or a loss on revaluation, we should go ahead and calculate the carrying amount of the asset at the date when this question was, at the date when they were doing the reporting, because they reported on 31st December 2018, but they did the revaluation on 1st January 2018. So our first task is to look at what is going to be the carrying amount at the date this asset was revalued. That's basically what we are going to look at. And when we get to know that, then we can be able to do the other one with ease. Okay. But as we said, this is a reporting paper. We need to first do give some explanations of the things we are doing. So we may define some of the things that we said. When we go to the revaluation, we said these assets are going to be carried. The asset, we say the machinery, because it was stated, the machinery will be carried at the revalued amount. Valued amount less any accumulated depreciation, accumulated impairment loss. That's basically what evaluation means, or the evaluation model means. And when you have given that, you can be able to go ahead and do the analysis of the debts. First of all, we need to analyze the debts because the asset was bought from 1st January 2013, and they did the revaluation on 1st January 2018. So how many years are there from the date the asset was bought to the period when they did the revaluation. We start with the 2013 because it was at the start of the year. It was 2013, 2014, 2015, 2016, 2017. We don't count 2018 because 2018 is at first January, meaning it wasn't a full year. So we have only 5 years, meaning this asset was revalued after 5 years. So now we need to know the carrying amount of the asset from the date it was acquired. We need to know that. Remember from our previous example, we said that the cost of the asset was 70 million. The annual depreciation was computed it, which was 3.65. But this time around, we are not multiplying by 6, we are multiplying by 5 because they are 5 years. The evaluation took place after 5 years. So what will be the carrying amount of the asset from the date the asset was acquired to the date when the revaluation took place? It is going to be 54.75 million. The other person could say to get this carrying amount using this, because the one we did up here was for 6 years. Meaning that if you want to go backwards by 1 year, you just add back depreciation. You could just add back, you say that the depreciation, this 5.51.1, then you add back plus the 3.65, because that is the depreciation for 1 year. You will still get the same answer, which is 54.75. But it's better you go in this way so that you don't get confused. So that's basically what we do to get the carrying amount of the asset. Now this carrying amount is at the same date when the revaluation took place. So when you have got that, then we say the revalued amount. Now they say they revalued that asset at the revalued amount is now equaling to 60 million. That's what they gave us in the question. So when you look at that, then we try to compare. We said to get a gain or loss, we get the revalued amount minus the carrying amount. So when you see that this is 54.75 million, but this one, the revalued amount was 60 million. It means we had a gain, meaning we have a revaluation gain. The revaluation gain, and that revaluation gain is coming from the 60 million minus the 54.75 million, which will give us 5.25 million. And this is a gain. So when we have got a gain, what do? We do the double entry, because when you get a chance of making these double entries, please go ahead and do them, because these are the ones that are helping you to explain more, or to give the person who is viewing more clarity on certain items, because we are reporting some of these guys who don't even have any accounting background. We said we go ahead and debit the machinery, because now the machinery is going to be increasing in value. It is increasing by that revaluation gain. So it is machinery or the other person could say PPE, because that's the general name, PPE, and we are saying it is 5 5.25 million. And now we are taking this figure to OCI, meaning we are going to be creating OCI in terms of the evaluation gain. The evaluation gain of 5.25 million. That's basically the double entry that you would have made from that point. But remember, these values, they are at 1st January 2018. So the figures we want now, we want figures that we are going to be using. We want figures that we are going to be using as at, let me just put at the end of the year. End of the year. End of the year. 31st December 2018. Those are the figures we are looking for. And these ones, we are going to get them through computing. Now we are going to be computing depreciation. And this depreciation is going to be the depreciation that has came in as a result of the revaluation. And the reason why we are going to be computing another depreciation is because these assets now from that date of 1st January 2018, it's no longer going to be carried at the previous amount. It's going to be carried at the revalued amount, of which the revalued amount is now higher, which is 60 million. Meaning that even the depreciation is also going to be high. So we compute a different depreciation. Remember, if these years we had maybe the asset was revalued on 1st January 2018, but the reporting was maybe towards 2019, we could compute for 2 years. But since it is only a duration of 1 year, we are only computing the depreciation of the revalued amount for only 1 year. So we compute the annual depreciation. Annual depreciation, I need to use short form. And this annual depreciation is now going to be taking the revalued amount. It's going to be the revalued amount. We are not taking the cost because now there has been a change in the value of the asset. Less the scrap value. Then we divide everything by the remaining. Here we are taking the remaining useful life of the asset. A person may be wondering that if this asset was, even if they had said here that the remaining useful life, because they told us the remaining useful life was 16 years. But remember, in another sentence they said that the company does the revaluation after 5 years. It means if the initial estimated useful life was 20 years, and now they are doing the revaluation after 5 years, it means the remaining useful life would have been 15 years, of which it is not the case. The logic is that depreciation you computed, it was just an estimate. By the time they do the revaluation, they will also estimate that the asset may last for more years. So in any exam, don't be tempted to use the remaining, to just deduct and you take the 15. No, we take what they have given us as the remaining useful life. Please take note of that. You only do that maybe when in the question they have not given you the remaining useful life. They may tell you that we do the revaluation after 5 years. And they keep quiet and they don't tell you anything. Then from there you can deduct and say, if you do them from 15 after 15 years, and you've seen the 15 years have passed, you can less off and you go with the 15. But if the question gives you the remaining useful life, even if it is less than the remaining, please take what they have given you. So to get the depreciation is now going to be the revalued amount, which is 60 million. With less, of course, the scrap value is not there. They have not given us, so we just divide by the remaining useful life. And the remaining useful life, they told us it is 16 years. And this will give us 3.75 million. So that's the remaining, that's the annual depreciation for 1 year, meaning even in 2018, this depreciation is supposed to be taken to the profit and loss. Then now we can compute the carrying amount. Carrying amount, which will be equaling to the 60 million, which is now the revalued amount, minus the 3.75, which is the depreciation for that 1 year. This will give us 56.25 million. And this 56.25 million is the amount that is going to be taken to the balance sheet as the value for PPE. And that's basically what they wanted us to do in this question. So we can proceed and make these short statements. These are just extracts. Please, when you're told to give extract, don't put the whole balance sheet or the whole income statement like the way it's supposed to be flowing. This one, you just pick what is relevant. For this, we are going to be having, first of all, we have the depreciation. We go to the expenses. We have depreciation. Depreciation, now we are taking this 3.75 million. 3.75 million. Then we also look at, we had this revaluation again, which is supposed to go to OCI. We said the OCI, we have the revaluation gain, and the revaluation gain was 5.25 million. I can put this one the other side. Minimize the space. Then we try to look at the statement of financial position. This statement of financial position, we shall start with the net non-current assets. current assets, and you have our PPE. Remember, these PPE, you combine everything and give them at once. This is going to be carried at 56.25 million. Then the last one, we shall have the equity, where we are going to put our revaluation reserve. This is the valuation reserve, where we have all these figures. And the revaluation reserve is going to be showing this 5.25 million. And that's basically what this question wanted us to do. It's 5.25 million. That's basically what we're supposed to do in this question. And we get all those marks as you have seen. I'm trying to remove these. I'm trying to remove these borders, sort of the grid lines. You'll be able to see something that is basically what they wanted us to do. And that's all for these computations of PPE. But maybe to give you a small matter on the disclosure requirements, I've been skipping it, but allow me to talk about some of these. What are the things that disclosure requirements, or what are we supposed to disclose as far as PPE is concerned? IS 16. One, we may disclose the depreciation method we have used. Remember, here we've been talking about cost minus the scrap value over the useful life. What is that? That is straight line method. So when in the disclosure requirement, we are required to disclose the method we are going to be using to depreciate these assets. Remember, as far as standard this IS 16 is concerned, it allows some few methods of depreciation, reducing balance and straight line. Those are the ones that are mostly used. Maybe even number of years, digit, whatever method. It's also been accepted, but these other ones, most of the times we use straight line and reducing balance. Then the other one is the basis, the measurement basis used for determining the carrying amount. Like now here we are using the revalued amount, and we are using the revaluation model and the cost model. Those are the measurement bases. We disclose that in our financial statements, when we are valuing items of PPE, we used we use the cost model or a revaluation model. You can't use both, depending on the policy of the organization. And remember, these policies, if you have decided to go by the cost model, you have to be consistent, and you'll be using that for some period of time. Then the other one, the useful lives. Remember, we've been saying that the useful life of these assets is going to be changing. You may find that other companies, they are depreciating maybe their computers for 10 years, others are depreciating them, depending on how they are able to estimate the would-be useful life of that asset. Then you can talk about the accumulated depreciation and accumulated impairment losses that are there at the beginning and the ones we have ended the year with. The depreciation, the accumulated depreciation that we had at the beginning of the year, and the one at the end of the year, so that someone can get to know that if I get this accumulated depreciation at the beginning and the one at the end of the year, I may be able to know that the balance is going to be the depreciation. If at all no assets have been acquired and no revaluations that were there, you may find that the difference may account for the depreciation. So it gives some information to the users on how certain things were done, even when they don't have accounting background. Because most of these things, like you state the method, and you may also illustrate how the method is, that it is cost minus the scrap value over the useful life. Someone can be able to pick and interpret the financial statements. That's basically what we can talk about. The other disclosure requirements, which I have not talked about, can do some reading on your own, and you have something to add on what you have acquired. Thank you for today. The next one is going to be IS40, and we are going to be looking at some of the simulations that we had in that, and we shall be able to do some numbers and be able to understand more as we go on. Thank you. Endeavor to subscribe and share to others so that they can also have benefit. Thank you.